Hello, Fast Graph subscribers. This is Chuck Carnevale, co-founder, aka Mr. Valuation. One of the most often questions we get and some of the biggest confusions we get is about the blue line on the Fast Graph, what we call the normal PE. And so I prepared this little tutorial to kind of help you understand what the normal PE is, why we add it to the graph, and then how you can best utilize it to help you make better learned, more safe, and prudent investing decisions, buy, sell, or hold in the long run. Because one of the things that I stress all the time to subscribers is I want you to remember that FAST stands for the Fundamentals Analyzer Software Tool. That's what the acronym is about. It's an analyzer tool. It provides you metrics and visualizations that you can utilize to analyze the various companies that are behind the stocks that you're thinking about buying and adding to your investment portfolios or that you already own. So let's go ahead and get into the Fast Graph tool, and let's look at what the blue line or the normal PE ratio is, how we calculate it, and then how you can utilize it to help you make better decisions. I'm going to start out by using Microsoft. And I like to use this example because the first thing I want to point out is that what the normal PE is, it's really a trimmed average where we take a period of time. In this case, we're looking at a 2-decade period of time. And we throw out the high PE and the low PE, and it just becomes a trimmed average. And another way to look at the blue line is that it is the PE that best represents how the market has valued the stock over any given time frame. But I think the most important point, or a couple of the most important points are, number one is it's a very dynamic calculation. When you change time frames, you're going to get different perspectives. I think it's also important to point out that it does not necessarily indicate that that's the price you should be willing to pay for the stock or that that's a fair price for the stock. It's simply the price that the market has been applying over whatever time frame you're looking at. And that's very dynamic. Now, the reason I chose Microsoft is because if you look at this graph, you see that the normal PE is 19.95. We'll call it 20. So the first thing I know is that this blue line represents a PE ratio of 19.5, or 20, if you will. No matter where you touch this blue line, it's a PE of 20. And if you're touching the stock, when the stock is touching that line, it's going to be trading at a 20 PE. Now, obviously, common sense as you analyze this over this long time frame would simply tell you some very important things. Number one is, for the last 5 or 6 years or so, Microsoft has traded at a much higher PE normally. So the normal PE, although accurate for this time frame, doesn't really apply to this time frame. Likewise, there was a period of time here coming out of the Great Recession where Microsoft was trading significantly below the blue line. And clearly the blue line now, since the price never touched that, does not represent a good market value. It's an accurate calculation for the time frame being presented. So let me do some things to clarify that for you. For example, if I take the scroll bars here and scroll to the period of time here that you see on the graph where Microsoft was trading at a lower valuation, you see that the normal PE here is 12.8. But once again, that's comprised of a period of time where you see PEs of 10, 11, even single-digit 9 PEs, also mixed in with PEs of 17, 18, and so on. So now if I scroll out some more of this, get rid of a couple of the real high years and only look at this 3-year period, the PE ratio from, 2011, 12, and 13, the market was only willing to give it about 11 multiple and sometimes much lower than that. Now, what this is accurate historical information. It gives you that perspective. Conversely, if I move this up to more recent times, you can see that the normal PE since 2019 for Microsoft has been 25. Just because that's how the market has valued the stock doesn't mean that you necessarily should be willing to pay that. It's simply showing you how the market has valued the stock over a given period of time. Now, let's look at a couple of different examples here that are interesting to help give some more clarity. Let's look at a company like Medtronic and see how the normal PE applies to this company. All right, now let's analyze what we're looking at. Let's start with the 20-year graph again, and let's analyze what we're looking at. The calculation for this 20-year period, although mathematically correct, is almost useless. And I want to clarify that because we're saying the normal PE was 19.9. Now, what that does tell you is that the market, because, the fair value PE should be 15. That's what the formulas for, discounting, cash flows back to the present value would indicate. This should be a 15 multiple company. And we see that there were periods of time where it's traded at less than a 15 multiple. But if you look at the year, 2001, 2, and 3, this was still coming off of the irrational exuberant period where Medtronic was trading at a very high PE ratio. Once again, the blue line is accurate, but it doesn't really reflect the various time frames. So once again, we can take the scroll bars and scroll back in time and look at this beginning period here. And here we see that Medtronic was trading at 31 times earnings. Now we can just move this around a little bit and see now the PE for this time frame is only 21.12. And again, for most of that time it worked, but there was times when it was lower and times when it's higher. It gives you a valuation perspective and understanding. Then we go coming out of the Great Recession, which is connotated by this gray area. We see that there was a period of about 3.5 or 4 years here where the market only applied a 12 multiple, even though the growth rate of 6.45% would have indicated fair value at 15. So what this is doing is providing you information that you can evaluate over these different time frames. Now, another way to use this is not do the scroll bar like I did, but simply, go into the max graph, okay? And what you're doing here is you're seeing that the company grew by 7.48% over this time frame, okay? And the normal PE was 19. But I also want you to note you can do simple back testing. You can see if you were paying a high excessive valuation like at the beginning of this period here, and I just picked an arbitrary spot and held it, through the, this would be kind of like the lost decade concept that was talked about. You actually would have lost money or barely broke even, and this includes dividend income. You'd have actually had an 11% loss of capital. So the bottom line is this indicates how valuation matters, and it matters a lot. But you can also use this tool to show you when the optimum time to buy, sell, or hold the stock is. And clearly, the best times to buy a stock like Medtronic is when the price is below the orange line, the real fair value line, because here, even if you get into, fair value like we are now, you end up making 9%. In contrast, if you, bought the stock here and held it to where it became moderately overvalued, let's say at the end of 2021, your rate of return becomes 12.8%. Now, I don't know that it's wise or prudent to say you can count on that because you got to count on the market overvaluing the stock. All right. And so, it really comes down to the point that the market, values these stocks according to the growth rate of the company. Now, you look at a company like Ameriprise, it's historically traded pretty much at the 15 PE ratio, as will be indicated. But even then, you can see that the blue line here is a 13 PE because there are periods of time when the price is below the blue line and very rare times when the price is much above the blue line. So you could use the blue line in this example as kind of a fail-safe. Now, you can also take looks at companies like Echolabs, for example. Echolabs is a company that, for whatever reason, and Fastgraphs isn't going to answer that for you, here we have a 10% grower, A- rated company with 51% debt, and the market typically wants to trade this at around a 25 to 30 multiple. Now, I want to also interject that the number, obviously the algorithm does the math and it puts a precise number here. But again, that number isn't really perfect because you want to look at whether that number, it's a range. 25 to 30 might be the better way to say what the 28 is. For example, if I drop this to say 15 years, then my normal PE stays at the 2880. But if I drop it to 10 years, now the normal PE goes up to 32 for this period of time. But that's only because I've got some really excessive PEs here, which were a clear indicator that the stock was overvalued or should have been a clear indicator. So the reality of it is you're using the normal PE as a measurement. Now, the information here on Echolabs is that the stock always trades at a premium PE, or most of the time. We had one brief period of time, literally just a couple of days coming out of the Great Recession, where you could have theoretically bought this stock at a fair value PE. So, if I compare that again to a stock company like Ameriprise that I just had up there, you look at a company that grew at 12.5%, and it's only traded at a 13 PE, is also an A- rated company with 52% debt. So very, very similar characteristics. But what Fastgraphs is telling you, one, the market always has put a premium valuation on. The other, for whatever reason, they've put a negative. We don't necessarily give you the reason, but we give you the information that you can look at. I think that's really critically important. So once again, as you're using the tool, you're using it to think with. You're trying to say, what do I see with that blue line? It becomes a clear, representation of how the market's been valuing it. But once again, I want to point out that this line, also gives you perspectives of how valuation can really impact your rate of return. Here you've got 16.25% growth, which was extraordinary, but because you'd have paid a high PE of 35 and then held it to a low PE of 22, you only made 4%. In other words, you did not participate in the growth of the company by overpaying for the stock. That's another thing that the normal PE and these value references give you. Here's even a better example where the market was pricing this, well above 21 times earnings, which was the normal PE for most of that period of time, but the stock ended up being very undervalued. You ended up getting an 11% rate of return. So you can use this tool. Now here, it's interesting. It started out at 11 PE. Theoretically, it should be 15, but the growth rate was 6.45%. And you're going to get a calculation here that's going to be very close to that growth rate, just slightly adjusted because of the fact that the stock was slightly undervalued here and slightly overvalued here. Okay, so, this is what I mean when I say buying at fair value allows to fully participate to the full measure of the operating results that the company generates on your behalf. Now, a couple of other aspects that I haven't covered yet about the normal PE I think are also worth mentioning, and that is that, not all companies have PEs that are, above the orange line. For example, if you look at a lot of financials since coming out of the Great Recession, we'll use Aflac as an example, we see a period of time in the beginning when the PEs were high, and so we get a 12.47 valuation. But look at this whole stretch of period here where the PE was low. And what we see is that since the Great Recession, what I can surmise from this, and remember, this is factual, actual information. This is real. This is what happened. This is not projection. This is not forecast. This is reality. So if I use my scroll feature here and I scroll up through the Great Recession, and, all of a sudden now I see the normal PE for Aflac has been something like 10. So, logic would say if you're going to buy this stock today, you'd want to be looking at it in a normal PE. Now, how that translates to the forecasting graph, if you use the 15 multiple, like typically, it would indicate, you would get a nice, real high rate of return. But if you use the historical normal multiple for the last 5 years, which the tool automatically defaults to, your rate of return would be only 4.5%. And again, that includes dividends, which are, 2.69% in this base at this time of buying the stock. So what the normal PE is, it's simply a valuation reference. It allows you to evaluate companies and look at them and be able to determine how the market normally treats this company and whether the current valuation is high or not. But I do want to make a point. If you're looking at a stock, like, for example, Apple, okay, you can look at it historically. You can see the market had a lot of periods of time where it traded below 18 times earnings, which is the blue line on this long-term graph here. And there were lots of times where it traded at 13 and 14 times earnings. Okay, and again, if I use the time frame feature here, all of a sudden we can see the normal PE going back, to 2012 or just the end of 2011 has been about 16, and it's currently trading at 25. So that would indicate it's a very high valuation, even for a company that's growing at 16%. Now, you still have to make your own decision. You still have to decide whether you're willing to pay it or not. If you look at a company like Echolabs that I showed earlier, you'd have to decide, are you willing to pay that PE? If you looked at a company like Aflac, you might want to make the conclusion that I don't want to pay a PE much over 10 because that's how the market's been valuing the stock. But the point is, it's a tool to think with. It helps you make good decisions based on real-world factual information that has already happened. Now, there is a little bit of forecasting data included, but you can even get more precise. Here we got 16.16% growth rate. We can take out the forecast data, and we get all of a sudden 18%. Now the blue line is, a normal P of 16.5, but the orange line is the PE of 17.97. We're using the P equals growth rate formula. So again, you can think your way through the investment. You can use some of the forecasting data. You can scroll some of the forecasting data at. The real beauty of the FastGraph tool is it's a dynamic tool, and it allows you even to do simple things like if you could buy Microsoft at a really cheap price, that really gives you the ability to generate incredible rates of return. If you overpay for the stock, your annualized rates of return, even if the stock is still overvalued, shrink dramatically, but they're still good because the company has grown a lot. And I can also look at this graph and see that we had an anomalous 71% growth rate in 2021, which Apple has a September fiscal year. And, that explains some of the, we'll call it irrational exuberance or some of the, optimism for the stock. But then now we're going down into single digit rates of return. So if you were going to invest in Apple, you'd want to be thinking about a forecast 7% growth rate, maybe more prudently than a past growth rate of 18%. This is a tool that will help you make good long-term investment decisions and help you decide whether a good time to buy, sell, or hold the stock is. And you can really see that when you get into situations where the stocks get dramatically overvalued. Like, for example, the well thought of PayPal Holdings was so massively overvalued, and it's been falling into what appears to be, approaching fair value, but really the culprit was overvaluation. So again, if you bought PayPal back here, say at a maybe slightly fully valued or reasonable valuation, and held it into here, somewhere along here, it would have been prudent to sell the stock. Because if you sold it here and not harvested the full measure of the top, you'd have still saved yourself from losing 59%, or an annualized loss of 42% for those next couple of years. That's what the FastGraph tool does. If you bought the stock, cheaply or reasonably cheaply, even through this period of time where the stock has moved back into value, you still make a pretty strong rate of return. Think with the tool. Use the information the tool delivers to you to make better investment decisions. Anyway, this has been Chuck Carnevale, co-founder, aka Mr. Valuation. First of all, I want to take this opportunity to thank you all for being subscribers, but we're going to be doing these tutorials a lot more now because we've kind of moved into what we believe will be a much better software platform for FastGraphs than we've had in previous years. And now it's time for us to help educate you on how to get the most maximum benefit and use out of the FastGraph tool. We hope it helped. We thank you for watching and look forward to a long and happy and prosperous time together as part of the FastGraphs family. This is Chuck Carnevale. Thanks for watching.